Hey guys, so Dev here again. In the previous video, we covered the balance sheet. In this video, we're going to cover the cash flow statement. So, what is a cash flow statement, right? It's nothing but a statement that shows you how changes in the P&L and changes in the balance sheet affect your cash position for a given period of time, like a month, 2 months, a year, because almost anything and everything on the P&L and the balance sheet changes, affects the usage of cash, right? Either directly or indirectly. Now, the cash flow statement has three parts: the CFO, which is cash flow from operations, CFI, which is cash flow from investing, and the CFF, which is cash flow from financing. So let's start with CFO first, right? So, what is CFO? It tells you how much cash you have generated from your operations. Now, what do I mean by that, right? If you go back to the P&L, let's go back to the P&L, you will notice that EBITDA and EBIT are both proxies for pre-tax operating profit. Now, why am I saying that? What does that mean? So look, what up till the EBIT level and the EBITDA level, what costs do we cover? We cover material costs, employee costs, basically all of your OPEX items, and depreciation and amortization, right? These are all the operating costs that you have in a business. However, interest is a cost, which is, it's not an operating expense, it's a financing expense. It's a function of what my capital structure looks like. Now, what do I mean by that? Remember in the sources and uses, when we started this business, I assumed that I would be putting up 1.5 lakhs and the rest would be funded through debt. Now, if I'd put this entire amount of money as equity capital upfront, I would have no debt requirements. And if I had no debt requirements, I would have no interest expense, right? So from that perspective, interest is a financing expense. It's not a operating expense, and hence we have to adjust for that in CFO. So we will come to that. So that being said, let's go back to the CFO. How do we start with the CFO? We start with PAT, which is nothing but profit after tax. Drag and drop this. Now, remember, right? What is PAT? It's profit after tax, but it has been computed on an accrual basis. There are a lot of items in the P&L which may or may not be cash items, and we have to adjust for all of those to see how much cash our operations are actually generating. So let's start with the first non-cash expense, right? D&A. Remember D&A, depreciation and amortization. Remember, as I told you earlier, D&A represents the wear and tear of your fixed capital items, right? The tax authority gives you credit for spending on your fixed capital items and then allows you to spread or release those costs over a period of time. But think about the timing of these spends, right? When you invest in fixed capital, you spend the money up front, the money has been spent already, it's capitalized on your balance sheet as PP&E, but you're going to be releasing the spend over a period of time. In our case, it's 24 months, right? Because we've taken that as an assumption. Don't anchor yourself to 24 months. And this quote unquote D&A cost is tax deductible by the tax authorities, but in a given period of time, it's not a cash expense, right? We don't lose money. We don't pay for the depreciation and amortization. Let's take an example to make this slightly clearer. If you buy a car, let's say has a life of 5 years, and you spend 5 lakhs upfront to buy it, it has a life of 5 years, and after every month, right, it will depreciate by 5 lakhs by 60, roughly 8,333 bucks. Now on paper, when I compute my taxable income, I will be allowed to subtract this 8,333 from my taxable income. But at the same time, I don't, this 8,333 in depreciation expense is not a real cash item, right? I'm getting credit for it to decrease my taxable income by this amount, but I've not paid a cash expense to the tune of this 8,333 rupees, right? So net, I've got to add it back to PAT. This is the first adjustment we make. So let's just add this back to right now. Next thing, let's go to changes in working capital. So remember, we discussed what working capital was, right? In the sources and uses video. Now, why are we accounting for this in the cash flow statement, right? So let's just go above and take a look at some of the NWC items, working capital items, and how they relate to items on the P&L. So let's go one by one. Let's take money earmarked for salaries at incubation. What does this line item correspond to on the P&L? Corresponds to employee costs, right? What does money earmarked for transport correspond to? Transportation costs, right? The same thing for rent and utilities, and inventory corresponds to material costs, right? Now, remember what I said, right? When we started this business, that we didn't know how the business was going to ramp up, and basis that we capitalized certain budget for all of these items upfront in case we couldn't generate revenue to pay all of these costs if and when they were incurred. Now, in our case, luckily, we ramped up revenue. We sold 1140 or so units of Pulao in the first month, and hence we generated cash from operations. But because we budgeted for this on the balance sheet, we are paying for those costs from the balance sheet, from the cash that we've kept on the balance sheet, even though we can pay for it from the operations, right? So in essence, it's being accounted for twice. So we have to make that adjustment on the cash flow statement. So the way to think about working capital, change in working capital is, right? Let's think of it from an accounting entry perspective, very basically. Accounts assets is equal to liabilities plus equity. On the asset side, if there's an accounting transaction, say an NWC item goes up, working capital item goes up, and the corresponding entry has to be a cash entry. And there's nothing happening on the other side, nothing on the liability side, nothing on the equity side. What's going to happen? If an asset goes up by, say, $100, cash has to go down by $100, right? If cash is the balancing entry to make the accounting balance sheet balance. So when a current asset item on the asset side goes up, cash will go down. When it goes down, cash will go up. By the same logic, on the liability side, it'll be the exact opposite, right? When, say, something like payables goes up, or you raise debt and the corresponding entry is a cash entry, cash has to go up, right? To make the balance sheet balance. The way we're going to account for working capital, change in working capital, is for the asset side, it is going to be the previous month minus the current month for all these items. This minus this, plus this minus this, plus minus this, plus. Right. Have we missed something? Yeah, we missed payables, right? But for payables, will it be month 0 minus month 1, or will it be month 1 minus month 0? It'll be month 1 minus month 0, right? Because increase in a liability imputes increase in cash if nothing else changes. So it'll be A minus B. Let's drag and drop this. Okay. Now I understand this could be slightly confusing for you guys, but remember, right, when we discussed this line item for the first time, we assumed that 20,000 rupees was going to go from this amount of cash earmarked for salaries in the first 6 months and not from the revenue, in case the revenue wasn't enough to pay it. In this case, the revenue is enough to pay it. So net, as the money is going from here on a cash basis, this item is actually going to be 0. So that's being reflected over here. We are done with working capital. Interest expense will come from the debt schedule. So that's going to be in the next tab. We've got to add it back because this is like a little bit of accounting jargon, but we'll be adding it back because we're subtracted from PAT, right? Pre-tax, but nonetheless. Let's compute CFO. We have the CFO, right? Now, let's move to the CFI, right? What is CFI? Cash flow from investing. Hey guys, so now we've done with CFO. Let's move to CFI. So what's CFI, right? It's cash flow from investing. Now, what does that mean? This basically captures the cash that is being spent on adding to your fixed capital base, your PP&E. So in this case, typically we will have two types of capex items, right? We will have growth capex in case we're going to grow this business. In the case of Dev's Pulao, for this 12 months, we're not going to grow the business in terms of our core capacity, but we have to at least maintain the wear and tear that our business faces, right? In terms of the utensils, the kitchen slabs. So just for the sake of this case, let's just assume the capex is going to be same as the depreciation amount. Your fixed capital depreciates and you just add to that just to make sure you are replenishing what has been depreciated. So let's just do minus of DNA, CFI, like this, sorry. Okay, why is it negative? Because it's a cash outflow, right? It's a cash outflow. Like I'm spending 4,781 bucks to replenish my fixed capital base that is eroding. Now, let's move to CFF, right? So cash flow from financing, which shows us the net money that's being used to fund the company through equity and debt. So we will cover change in debt, interest expense, and change in revolver in the debt schedule, which is the next video. For now, let's go to the other two items, equity raise. So this line item primarily includes fundraisers, if any, right? If we raise further equity capital from investors, if I put more money into the business, so I get external money to come into the business. So for the sake of this case, let's assume there is no external capital that is invested in this business. We have 12 months and dividends. Once again, I think it'll make more sense if we cover dividends in the debt schedule and it'll be clear why. So let's leave that for now. So let's just compute CFF. We put the formula in, right? And now let's go to this ending cash over here, which was 0, beginning cash, ending cash. Change will be nothing but CF4, CF5, CF. Sum these up. Just drag and drop all of this. Let's link this back, cash item back to the balance sheet. So now, and then cash. Whoops. Sorry for that. That's okay, so we've linked the cash. I don't know why this is happening. Yeah, guys. So in this video, we've covered. Hey, boss, stop recording. What the fuck? Hey, guys. So this cash line item right now, we just plugged it in. It's not the right value. I mean, it'll compute itself once we complete the entire debt schedule. We've just linked it for now. So in this video, we covered the cash flow statement. In the next video, we're going to cover the debt schedule. And then finally, we're going to link the entire model up, and then all of the lines that I've highlighted in yellow are going to disappear because it's going to be interlinked. See you guys over there. Hey guys, so we covered the cash flow statement in the previous video. In this video, we will cover the final piece left, the debt schedule, and then compute all of the pending items and link them together, get a fully functional three-statement model. So let's start with the debt schedule, right? What is the debt schedule and why is it used? So what the debt schedule does is it tells us how much interest we need to pay on all sorts of debt that we have. And if at all there are any cash flow shortfall requirements that we are facing in our business through which we're going to have to pull down on a revolver balance. So let's begin with it. So I will first link in all of these items, then I will explain to you the structure of why each of them has been included in this line item, right? So let me just change this, make this dividends, sorry. Yeah. So for any given period of time in a month or whatever, you will start with the beginning cash, right? Purely from a cash perspective. Then we will add, I've said FCFF here, which is nothing but a proxy for cash flow from operations plus cash flow from investing. Don't confuse this with the FCFF and the FCFE that you typically read up about in corporate finance. So just stick with me here and add CFO plus CFI. So you started with a certain amount of cash this month. Your business generated so much in CFO. You invested so much back into the business in terms of CapEx and CFI. Next, you will subtract interest expense, but we will compute that in a short bit. So let's leave that be. Plus changes in debt, right? So what this line item is trying to really account for is if you raise debt, this will be a positive number. If you pay down debt, this will be a negative number. So how much debt do we currently have? We have about this much on our balance sheet, the amount that we raised when we started the company. And we're going to pay down this debt over 24 months, right? As we said in the first video. So every month, this balance is going to be decreasing by this divided by 24, right? So let's just do this. Yep. So this is nothing but the previous month's balance minus the starting balance divided by the amortization period for debt, which is 24. So in the first month, the debt will decrease by this minus this, second month by this minus this. Let's plug that back in, right? So in this case, this figure will be a negative item. It won't be a positive item. So it will be this. Rather, it'll be, sorry, it'll be this minus this. Yeah. Debt. Okay. So far, we started with beginning cash, then we went to CF4 plus CF5. We're computing interest in a bit. We got the change in debt. Let's just link that here. Nothing but this. Just link this over here. Yep. Let's pull this also over here. Right. Next line item is minus minimum cash. So what is minimum cash, right? Cash that I might just want to always hold on my balance sheet in case I have like a working capital problem or my business shuts down because of COVID. Let's assume this to be zero for the sake of simplicity. You can assume it to be anything, 5,000, 10,000 bucks, just cash that you want to keep in the bank always. We've already kept cash in terms of money earmarked for salaries for transport, rent and utilities. So I'm going to put this to zero. But if we didn't have that line item, you could have budgeted a certain amount for this plus equity raise, right? So once we go from beginning cash, we had CFO, we had CFI, we had the change in debt, we have subtracted the minimum cash requirements. And now we will, if we raise money in this period, this would have been a positive number, right? So that would have given us more cash to deal with. So we'll add this over here. Just sum all of these items. So this in a given month is the cash that I have available to pay out dividends to myself, to all the equity holders, if I wanted to pay dividends out, right? So from this balance, let's say I don't want dividends until I'm a debt-free company. So let's put this number to be zero. So hence dividend paid will be this into this, right? Let's just test this to see it's working. Suppose I put 10, how much would it have been? It would have been this. Let's link this back to the cash flow. Dividends will be minus of this, right? Because when I pay dividends, it's like I'm paying out dividends, right? From a company's perspective, it's money going out. we've come to dividends. Next, cash available for revolver. So remember, like I told you earlier, revolver is the last check to make sure if this balance, if basically this balance minus this balance is negative, means I need money, right? I need money to pay. I need to draw down money to cover my shortfalls in cash because my business is not generating money. So what will this number be? This will be this minus this, right? So let's just make this 0. It's simpler. Right. So what does this mean, right? 1.72 lakhs. What does this mean? This means I have cash before revolver. I have cash of 1.72 lakhs at the end of month 1, which means if I don't have a starting revolver balance, I will not require to draw down money to revolver because this balance is not negative, right? So let me just illustrate that to you. Ending revolver balance. Let's just link this here. Beginning revolver balance. How will the revolver balance change? If this is negative, we will have to pull down the revolver. If this is positive, we will not have to pull down the revolver. Plain and simple. If this is negative, means we need cash, right? We need additional cash to make sure our cash balance doesn't go to 0. If it's positive, everything is hunky and dory. So the changes will be if this balance is less than 0, we will pull this balance. If this balance is greater than 0, then, and remember, it's possible that this month's balance was negative, but then this month's balance was largely positive. And then hence from the cash flows that I generated in this month, I can pay down the revolver balance that was drawn up last month. So it will be minus of minimum of this and this, right? Let's do target. Let's test to see if our revolver works. Suppose I make this minus 1,000, right? Is the revolver working? It is, right? Because what does minus 10,000 here mean? It means that I've hard coded this number, so don't worry where it came from. But suppose this number came to like minus 10,000, would mean that I'm 10,000 bucks short of cash in my business, which means I need to pull 10,000 bucks in cash in the business. And that balance is being pulled through the revolver drawdown. So my ending revolver balance for the month would be 10,000. And the next month I generate 2.5 lakhs in cash. And from that cash, I pay down the revolver. So let's just go link this, right? Let's link the revolver balance to balance sheet. Okay. So we have this, and let's just link it to the cash flow statement, right? So change in revolver. Remember, signs on the cash flow statement are very important. One sign wrong and your balance sheet is not going to tie once you link the entire month. So change in revolver will be, let's just put it over here. 1, nothing fancy, right? Wonderful. So now the only item that is left immediately is interest expense, right? So remember, why will we ever incur interest expense? Because we have debt. How many different forms of debt do we have? We go to the balance sheet, we will see we have 2 forms, right? We have the debt that we raised to start this business, and we have revolver debt. The balance of the revolver debt is 0, but we could potentially have revolver debt, right? If our operations don't generate cash flow. So each debt item will have an interest rate and hence a corresponding interest computation. So we'll have to compute interest both for debt as well as for revolver. So let's do it first for debt, right? So interest will be a negative, right? It'll be a cash expense. So let's do average of the debt balance for these 2 months times the interest rate, but this is an annual interest rate. So let's divide by this by 12, right? This should be my interest for the first month. But we are going to put in a circular reference, and I'll explain to you why once we do the computation of revolver interest calculation. So let's just put this circ is equal to 0, 0, else this minus, let's just compute the revolver interest, right, for this period. Let's link this first, circ is 0, 0 minus this. So, right, how will we compute revolver interest? Average of starting balance, the ending balance times, let's just assume that it's the same interest rate, like this divided by 12 for a month should be this, right? Now, the problem with just doing this, right, is that, look, this interest computation that is going into the P&L. So this line item is going to flow into the P&L, right? Let's just link it here. Let's do minus of this. As well as it's going to go all through and through, right? Let's link it through. Four as well. Let's now look. Now look, what is this interest expense that is flowing through to the P&L, that is flowing through to the cash flow statement? It is the interest expense on the debt that we raised to start the business, and the interest expense on the revolver debt that we might or might not include, right? So let's just go to the computation of revolver interest. So there is a circular reference here. Now, what's a circular reference? When an input of a cell is linked to the output of a cell, and it just keeps going on in a circular iterative process, you get a circ. Now, you might ask me, why is this a circ, right? Okay, so let's see how revolver interest has been computed. It has been computed on the beginning balance and the ending balance, the average of the two into the interest rate divided by 12, right? How is the ending balance computed? Starting balance plus, if we require money for, if we need to raise money through a revolver, we will raise money, right? So it takes this as an input. Now, what is this as an input? It is nothing but cash available for dividends minus dividends, right? Following with me so far? What is this figure? What does it take into account when you compute it? It takes into account beginning cash, CFO plus CFI, and the interest expense, right? So essentially what's happening is the output is linked to the input, because this interest expense component here has interest on the debt that I used to start the business, as well as a revolver. And basis what that amount is, I'm going to have a cash flow amount here, and basis what this is, I'm going to have this balance, and basis what this is, I'm going to have the ending revolver balance, and basis what the ending revolver balance is, I'm going to have an interest computation for revolver, which is again going to flow into this, right? So we're going to have the problem with doing this, right? Is that fine when everything is going fine in the model, there's no problems, right? Like everything's fine. The Excel file is enabling circular computations, it'll compute a value. But for whatever reason, if there's an error in your model, you typed some alphabets into some cell and you do Control Z to go back. Because of the circular nature of this line item, the error is going to persist and you are not going to be able to cure it, or rather solve it without breaking the circ. So how do we break the circ? I've created, if you go to cell E2, I've created a cell which has an input of 0 or 1. 0 means the circ is off, 1 means the circ is on, and I've named it circ over here. So you can just circ, and once you do something like that, you can use the word circ in any formula across any of these tabs. So let me just right. This is the computation for the revolver, but if circ is equal to 0, if we switch the circ off, we need to break the circuit breaker, right? So at 0, if circ is 1, then we will compute this, right? So here, have we missed it anywhere else? Interest expense, we've included it here as well. That looks good. So we have this. Now let's just go back and fill in all of the missing pieces in the model if there were any, right? So what was that? We had PP&E. So what is PP&E? Property, plant, and equipment. How is this going to change? Any changes has to go through the cash flow, right? So we will augment this balance through the capex that we do. So that is this flowing through the balance sheet, flowing through the cash flow statement. And this balance will decrease by the amount of depreciation and amortization, which is this, correct? So we have this. Now the only balance that is remaining is the equity balance, right? So how does the equity balance change? We take the previous balance. What do equity holders have attributable to them? The profits of the business, right? So profit after tax. We will add this, but is this it? Or will there be another adjustment to this? There will be another adjustment, right? We will have to subtract dividends. Subtract this. 1 minute. Let me just see that I've gotten the signs right. Dividend payable. Is this into this? Okay, this is positive. And this is negative, so it will actually be 1 plus 2 plus 3 and not minus 3. Okay, so we have this. Now, have we linked everything? We have revenue, we have PAT, all the balance sheet items are linked. All of this is linked, but the balance sheet's not tying, right? So what have we missed? Let's go one by one, see if everything is going through. Just expense here. Have we forgotten to link something? So one by one, 9536, right? So the error is here, right? So I messed up with the signs. Remember, I mentioned to you signs are very important. One mess up in signs and your balance sheet won't die, which it's not right here, right? So there should be PP&E plus capex, right? But this figure G60 is negative. So this should be minus this plus this. I should click this, and now my balance sheet dies. Well, hey, right? We've gotten a 3-statement model that's completely linked. Let's just take a look at it. So we have revenue, material cost, material margins, EBITDA, EBIT, profit before tax, PAT. Why is this negative? Because again, boundary condition, right? We had come up with a borderline pricing level, which is break even. So because interest is circular in nature, this is close to being a break even level. Don't worry about this now. We'll come back to this in a bit. We have the balance sheet. All of these working capital items, which were prepaid, go to 0 by month 6, in some cases, month 7, month 8. Inventory scales up with the number of units that you produce. PP&E stays net the same because whatever wear and tear you have in the business, you're assuming you're going to invest the same amount of money just to handle that wear and tear. Cash gets generated in this business as you launch your operations. Payables is just linked to the inventory balance, right? Your business is generating money, so there's no need for you to pull down revolver debt. You're paying down the debt that you used to start this business, and basis the profits that you make in this business, your equity, your net worth balance is going up. So I think now you have a linked 3-statement model of Dev's Pulao. I think in the next video, we're going to cover some of the key ratios that we typically analyze on the job in investment banking and private equity. So see you guys there. Bye. Hey guys. So in this video, we're going to cover some of the key ratios that are typically. Hey guys, Dave here. So in this video, we're going to cover some of the key ratios that we look at whenever we look at a business in terms of the three statements of the business, the financials of the business. So let's begin, right? Let's just add this month, month, 12. Okay, let's just add a few more ratios. 1, 2, 3. Revenue growth. Let's add material margin. Let's add EBITDA margin. EBIT margin. Hey guys, Dave here. So in this last video, we're going to cover some of the key ratios that we typically analyze whenever we look at a business, whenever we look at the three statements of the business and how they've been performing, right? So I added a few rows and metrics here from the previous file. So don't be worried if you see the entire row numbering of everything going down from there. So let's start with revenue, right? So, formatting. Revenue of this much. Let's compute revenue growth, right? So what is revenue growth? 1 divided by 2 minus 1. How much is that? The first month, the revenue grows by 24%, then 4.2, 4.1, 3.9, 3.8, and then it goes to 0. Why does it go to 0? Because we've assumed that the price stays the same, and at some point you hit like a stabilization in terms of the number of units of Pulao that you sold. Remember, this is happening on a monthly basis. Typically, you would do this analysis on a yearly basis if your model was yearly for year 1, year 2, year 3, year 4, year 5. Next, let's go to material margin. What is material margin? Nothing, but it's been computed here, right? We have it. One, drag and drop, nothing but your material profits divided by your revenue, which is roughly 30.2%. Why is that? Because we've assumed that, again, the cost of 1 unit of Pulao is going to stay the same at 120 rupees. Next, let's go to EBITDA margin. What is EBITDA margin? EBITDA divided by 8. So your EBITDA margin slowly improves and then stabilizes at 11.9%. Why is that? Because remember, right? Let's go up and let's see what EBITDA is and why the margin increases. So as and when you ramp up sales from 114 units a month to 1720 units a month, your fixed costs, which are your employee costs, the transportation costs, rent, utilities is a direct cost, but the other costs, because they are fixed costs for a given level of output up to a certain amount, as I scale up that output in terms of my capacity utilization, I realize more revenues at the same gross margin, at the same material margin, that results in a higher absolute amount of material margin in terms of a number. And all of that flows down right through to the EBITDA. So hence my margins going up. Next, let's compute EBIT margin. Is nothing but EBIT divided by revenue. Same rationale for this. It's just like a flow through because again, depreciation and amortization is the same for all 12 months. Next is PBT margin, which is after having subtracted interest, but before tax. Same thing here. PAT margin is nothing but your profit after tax divided by your revenue. Next, let's go to return on equity, ROE. Let me just write that here. What does ROE mean, right? So when I started a business, I started with debt and with equity, right? In terms of capital deployed. Now for equity holders, I put in a certain amount of money. In the case of this school, I put in 1.5 lakhs. As an equity holder, what am I entitled to? I'm entitled to the profits of the business, right? Even though they might be accrual profits and may not absolutely correspond with reality, that's fine. But how do you think about the returns that I generate on the equity capital that I put in? So it'll be nothing but the formula is profit after tax divided by the average equity balance. It's nothing but this by this. First month it's negative because I had negative PAT, but then that eventually scales up, right? Yep. Next is return on capital employed. How do I think about return on capital employed, right? So return on equity was everything that is attributable to the equity holders divided by the account on the balance sheet that represents what the equity holders investment is worth, book value. Return on capital tells you, it kind of tells you before at the operating level before I subtract interest, how much return on capital does this business generate at the operating level? So what do I mean by that, right? Remember we discussed that interest is a financing expense. So EBIT is a good proxy for operating profit. Now, this operating profit belongs to both the debt holders as well as the equity holders. When I say the debt holders, I mean the debt holders will get their interest back. And this, hopefully, if it converts to cash flow, will be used to pay down debt. And whatever's left will be accrued to the equity holders. So let's just compute ROC. ROC, this is, let me again clarify, this is pre-tax. Be nothing but EBIT divided by the total capital employed in this business. So what do I mean by capital employed, right? It is the amount of debt plus the amount of equity minus the amount of cash that I have in this business. So I have to take the average of 2 periods. This plus this minus this. Next, we have sales by total assets. This is an asset turnover ratio, right? So this tells you, which is sales divided by total value of your assets. This just tells you for each rupee of assets, how many rupees of sales do I generate, right? So this starts at 0.3, goes to 0.4. Next, let's compute sales upon PP&E, which is your fixed capital. So that'll be nothing but divided by this, which tells you for all of the fixed capital that I've capitalized on my balance sheet, for each rupee of fixed capital, how much in revenue do I generate, right? Next, let's look at core net working capital. So net working capital is typically, core net working capital is typically current assets minus current liabilities, and the current assets will include inventory and receivables, and the current liabilities will include payables. In this case, we do not have receivables because what is receivables, right? I mean, when I sell a product to a customer, he's got to pay me their money in cash. Sometimes he might pay me a certain amount in cash upfront. The rest of it he's going to pay me at a later date. The amount that he has yet to pay me will be capitalized on the balance sheet as receivables, but In the case of Dev's Pulao, because we're selling units of Pulao to customers at a cafeteria, we're going to assume all of the money is received upfront and hence there's no receivables. So it's going to be, so in this case, we only have inventory and we have payables. So it's going to be inventory minus payables, which is our core working capital, which is close to zero in the starting month and then keeps ramping up slightly. Let's compute this as a percentage of sales. This is revenue. Comes up to a large amount by the last month. Next, let's talk about total net working capital. So this will be all current assets minus all current liabilities, except for cash and except for short-term debt. That's going to be sum of 1, 2, 3, 4, 5 minus payables, right? Let's compute that as a percentage of sales. Next, let's just plug in the cash figure. Next, let's plug in the equity figure on the balance sheet or the net worth. Plug in the total debt. What will the total debt be? It's going to be debt balance that we use to start the company at the end of a given month, plus the revolver, because revolver is like a debt item, right? Next, compute total debt by total equity, debt to equity ratio. Next, let's compute net debt to equity, which is nothing but total debt minus cash divided by equity. Next, let's compute EBITDA divided by total interest for a given month, which is nothing but A divided by B. Just gives you a proxy of whether or not I'm generating enough money on an accrual basis to pay off my interest obligations. If at all that becomes a problem. Next, let's compute EBITDA by total debt. Total debt. Next, EBITDA by net debt, which is nothing but B. Next, let's see what the cash flow conversion is from EBITDA, right? So EBITDA represents an accrual basis, but a good reflection of a business is if it generates EBITDA and that EBITDA translates to the cash flow, right? So cash flow from operations. So let's go to CFO, divide that by CFO. Let's divide that by EBITDA. First month's a bit of an anomaly because remember we had working capital upfront. We didn't have payables in the first month, and that change in payables is resulting in a lot of cash generation for this business. Next, let's do CFO by total debt. Next, let's compute FCFF to total debt. So for the case of Dev's Pulao, I'm just going to assume FCFF is CFO plus CFI. Typically, you will make adjustments in terms of the tax shield or interest. We're not doing that here. Just keeping it simple. CFO plus CFI divided by, what were we doing? FCFF by total debt, right? So that's this figure. Right. Next, let's compute FCFE. So FCFE will be CFO plus CFI. So we've added back interest here. We're going to subtract interest back here. plus change in debt, right? All the cash that you have in the business before you pay down, and change in revolver as well. Sorry. All the cash that you have in the business before you pay down equity holders in dividends or you raise for the equity capital. This number we're going to divide by total debt, right? Total debt, which is over here. Yep. Now that we have a total ratios, I think we can move on to the next video series wherein we're going to cover a listed company wherein, you know, it's going to be a listed company that you're typically going to face in a 3 to 4 hour modeling case. And you're going to be expected to make a 3-statement financial model on it for a period of typically 5 years and then run a couple of valuation exercises. So we're going to cover that in the next course.
Hey, thanks a lot for watching the video. Hope you found it useful and also got a few actionable insights.
Check out our website and join the mailing list for regular content. Do spread the word and share it with anyone else you think might find this useful.